Krisis iklim sudah di depan mata, mengancam kehidupan, lingkungan, dan perekonomian kita semua. Indonesia menunjukkan komitmennya terhadap penanggulangan iklim melalui ratifikasi Paris Agreement dalam Undang-Undang Nomor 16 Tahun 2016 dan upaya aktif menurunkan emisi karbon sebagai bagian dari agenda keberlanjutan nasional dan global. Sebagai presidensi G20 pada tahun 2022, Indonesia juga mendorong G20 Bali Declaration yang mendukung finalisasi ISSB Standards untuk pelaporan keberlanjutan global. Standar ini telah didukung oleh IOSCO, G20, ACMF, dan organisasi internasional lainnya, serta 26 negara telah berkomitmen untuk menerapkannya. Komitmen terhadap isu keberlanjutan ini membutuhkan pendanaan besar dari investor yang semakin menuntut transparansi. Mengintegrasikan informasi keberlanjutan dan laporan keuangan kini menjadi kebutuhan utama bagi pasar modal, pendanaan internasional, dan perdagangan global. Selama lebih dari 50 tahun, IAI telah menjadi pemimpin dalam penyusunan standar akuntansi di Indonesia. Sejak 2020, IAI mengambil langkah proaktif dalam membangun infrastruktur pelaporan keberlanjutan melalui pembentukan Task Force Comprehensive Corporate Reporting yang diikuti dengan pembentukan Dewan Pemantau Standar Keberlanjutan dan Dewan Standar Keberlanjutan untuk memastikan tata kelola yang kuat. Saat ini, IAI sedang menyiapkan standar pengungkapan keberlanjutan yang merujuk pada ISSB Standards, melengkapi laporan keuangan dan menjawab kebutuhan pengungkapan keberlanjutan yang semakin mendesak. Penerapan standar pengungkapan keberlanjutan tidak dapat hanya sebatas penyusunan standar. Namun, penerapan standar tersebut memerlukan ekosistem laporan keberlanjutan yang memadai. Strategi penerapan standar pengungkapan keberlanjutan yang terarah dan komprehensif sangat penting karena standar tersebut merupakan inisiatif baru di Indonesia. Dalam peta jalan ini, IAI memuat strategi penerapan standar pengungkapan keberlanjutan sebagai berikut. 1. Tingkat kesesuaian standar. Hal ini untuk memastikan ketentuan standar sesuai dengan tingkat kesiapan perusahaan dan praktik laporan keberlanjutan. Kedua, tanggal efektif standar. Hal ini untuk memastikan perusahaan memiliki waktu yang cukup untuk menerapkan standar. Usulan aktivitas penguatan ekosistem laporan keberlanjutan di Indonesia diantaranya adalah 1. Regulasi penggunaan standar pengungkapan keberlanjutan. 2. Assurance laporan keberlanjutan. 3. Infrastruktur pendukung terkait. 4. Pengembangan kompetensi. Dan 5. Penyusunan standar. Peta jalan standar pengungkapan keberlanjutan menandai langkah awal menuju ekosistem pelaporan keberlanjutan yang kuat. Peta jalan ini akan memandu bisnis, regulator, dan pemangku kepentingan untuk mencapai pengungkapan keberlanjutan berkualitas tinggi yang selaras secara global.
Di tengah maraknya pilihan sertifikasi akuntansi saat ini, Anda mungkin bertanya-tanya, mana yang benar-benar diakui, mana yang menjamin masa depan karir Anda, dan mana yang kredibel. Regulasi terkini melalui Undang-Undang P2SK dan PP 43 Tahun 2025 dengan tegas mewajibkan penyusun laporan keuangan memiliki sertifikasi akuntan yang diakui secara legal. Pilihan yang kredibel datang dari akarnya. IAI merupakan rumah bagi profesi akuntan sejak 1957. Penyusun standar akuntansi keuangan dan penjaga integritas profesi akuntan di Indonesia. Dengan pengalaman panjang sebagai pengawal kompetensi dan akuntabilitas, IAI bukan sekedar lembaga, melainkan jaminan kredibilitas dan pengakuan nyata dari masyarakat serta pemerintah. Jawaban dari masalah tersebut adalah sertifikasi Chartered Accountant Indonesia. CA Indonesia tidak hanya diakui secara nasional, tetapi CA Indonesia juga dapat berjejaring secara global melalui Chartered Accountant Worldwide. Jangan biarkan ketidakpastian menghambat karir Anda. Pilih jalur yang pasti, pilih CA Indonesia. Daftar sekarang di CA Kompetensi Mastery Program.
Ikatan Akuntan Indonesia berdiri pada 23 Desember 1957. Akuntan muda tanah air mengambil prakarsa pendirian IAI, dipimpin oleh Profesor Sumarjo Citro Sidoyo. IAI didirikan untuk membimbing dan mempertinggi mutu pendidikan akuntansi dan mempertinggi mutu pekerjaan akuntan. Sejak itu, IAI berkembang menjadi organisasi profesi akuntan yang turut mewarnai sejarah perekonomian Indonesia.
Inisiasi penting selanjutnya adalah ketika IAI mengambil tanggung jawab menjadi standard setter untuk mendukung pasar modal dan dunia investasi Indonesia. IAI menerbitkan prinsip akuntansi Indonesia (PAI) dan norma pemeriksaan akuntan NPA. PAI nantinya berkembang menjadi standar akuntansi keuangan (SAK). terus tumbuh menjadi pengawal transparansi dan akuntabilitas perekonomian Indonesia. Dalam dinamika global, IAI menjadi pendiri dan anggota ACPACC, pendiri dan anggota ASEAN Federation of Accountants (AFA), serta Associate Member Chartered Accountant Worldwide (CAW). Di masa kini, tidak bisa dibantahkan, IAI berperan di
Assalamualaikum warahmatullahi wabarakatuh. Good morning, ladies and gentlemen, and welcome to the ASEAN Chartered Professional Accountant Committee, or ACPACC, Sustainability Practice Webinar. Connectivity to Financial Statement in Sustainability Disclosure. Ladies and gentlemen, this webinar is also supported by Institute of Indonesia Chartered Accountants, or IAI, and ASEAN Federation of Accountants. My name is Monica Nabilia, and I'll be your MC for today's discussion. Before we start our webinar today, I would like to greet our honorable guest, the Chair of ACPACC, who also Director of Financial Profession Development at Provision Ministry of Finance Republik Indonesia, Ibu Dr. Erawati. Deputy Chair of ACPACC Sustainability Task Force, who also IAI Council Member, Profesor Lindawati Gani. Deputy Chair of ACPACC Sustainability Task Force, Dr. Noe. Representative from ASEAN Secretariat, representative from Accountancy Monitoring Committee Indonesia, IAI Executive
IAI Council Member, Ibu Rosita Ulisinaga, IAI Executive Director, Ibu Elizarni Husin, speakers and moderator, distinguished guests, ladies and gentlemen, welcome. Ladies and gentlemen, to open our webinar today, I would like to invite the Deputy Chair of ACPACC Sustainability Task Force, who also IAI Council Member, Professor Linda Watigani, to deliver the opening remarks. To Prof. Linda, the screen is yours.
Okay, thank you, Monica. Good morning, Ibu Erawati, Chair of the ACPACC and also Director of Financial Profession Development and Supervision, Ministry of Finance, Republic of Indonesia. Good morning, Ibu. And then we have also here with us our speaker, Ibu Yuliana Sujono, member of IAI Sustainability Standard Board, and also the partner and sustainable leader of the Pricewaterhouse Indonesia. Good morning, Bu Yuliana. And then we have also another speaker, Dr. Robert. Good morning, Dr. Robert. He's a founding director of the Metis Institute for Climate Strategy from Singapore. Thank you very much for your participation. And then our moderator and as well as the vice chair of the Task Force of Sustainability Task Force, Dr. Noe. Morning, Dr. Noe. I hope you are here already. And he's also the chairman of the Professional Regulatory Board of Accountancy Philippines. So I think it is complete already with all of the speakers. And then I have also like to greet Ibu Rosita Uli Sinaga as the council member of the IAI and also Ibu Elizarni. Good morning, everybody. Distinguished representative from Asian Professional Accountancy Organization, regulator across Asian countries, standard setter, colleagues from the accounting profession, business leader, ladies and gentlemen. Once again, good morning. It's a great pleasure for Indonesia through Ikatan Akuntan Indonesia to host this inaugural session of the ACPACC Sustainability Practice webinar series in collaboration with ACPACC and also the Asian Federation of Accountants or AFA. On behalf of the IAI and also the ACPACC Sustainability Task Force, I would like to extend a warm welcome to all participants for joining us from across the Asian region. Today's discussion with the entitle of Connecting Sustainability Disclosure with Financial Statement comes at a very important moment. Across Asia, sustainability reporting is moving rapidly starting from awareness toward implementation. As organizations begin preparing for sustainability-related disclosure requirements, the question is no longer whether sustainability matters, but how sustainability-related risks and opportunities are reflected in the strategy, governance, business decision, and ultimately the financial outcomes. This is why connectivity does matter. Sustainability-related risk and opportunity is actually increasingly influence enterprise value, business resilience, financing decision, and also assumption use in financial reporting, capital allocation, and long-term performance. As a result, sustainability information should not be presented separately from the financial information. It should be connected to strategy, risk management, governance process, and also financial statement so stakeholders can better understand how organizations actually create and preserve value over time. This transformation actually reinforces the evolving role of our profession. Professional accountants are increasingly expected not only to produce information, but also to connect the information, bridging the financial and non-financial perspective to support high-quality decision-making as well as stronger accountability. Ladies and gentlemen, in Indonesia itself, we recognize the successful sustainability implementation requires beyond just standard. It required ecosystem. Through in the Indonesian Sustainability Standard Board, or we usually refer to as DSKIAI, has adopted actually sustainability disclosure standard aligned with IFRS S1 and IFRS S2 into Indonesia's Sustainability Disclosure Standard Framework, which we refer to as PSPK1 and PSPK2. This adoption reflects Indonesia's commitment to strengthening the transparency, improving decision useful information for investor, and also ensuring sustainability reporting support enterprise value creation rather than becoming merely just an additional compliant exercise and expenses for the institution. At the same time, we also understand that standards alone are not enough. Implementation requires capacity building, collaboration, and as well as practical support for preparers and also practitioners. Therefore, over the past several years, IAI has continuously expanded its sustainability initiative through leadership program for board as well as executive, sustainability reporting workshop, as well as implementation session, competency development program for accountants and preparers, and also dialogue involving business, academia, regulator, and international partners. Recently, we also facilitated the discussion through the establishment of the Indonesia Sustainability Reporting Forum, or ISRF, which was established as a collaborative platform to strengthen the sustainability reporting ecosystem in Indonesia. ISRF reflects an important principle, which is sustainability transformation cannot be achieved by one institution working alone. It requires regulator, standard setter, market participants, professional organization, academic, and business working together within the same ecosystem. We are grateful that this ecosystem building effort continue to receive strong support from regulators and self-regulatory organizations in Indonesia. Collaboration among regulators, capital market institutions, professional organizations, as well as market participants has become increasingly important in strengthening market readiness and encouraging higher quality sustainability disclosure. At the regional level, this collaborative spirit is also reflected in the establishment of ACPACC Sustainability Task Force, which was formed based on a shared understanding that sustainability implementation challenges across Asia required collective actions. Through this task force, ACPACC aimed to strengthen regional capacity building, encourage practical knowledge sharing among professional accountancy organizations, as well as support the implementation readiness across jurisdiction. Today's webinar series is one example of that commitment to turning sustainability discussion into practical action and shared learning across the region, especially Asia. Ladies and gentlemen, while Asian countries may at different stages of implementation, many of our challenges remain similar. We continue to navigate issues related to capacity, data availability, governance readiness, professional judgment, and of course, the need of organizational change. These common challenges create a strong case for regional collaboration and shared learning. This is precisely why today's discussion is important. We are fortunate to have perspective from both standard setters and practitioners because successful implementation not only understanding the standard but also understanding how those standards work in practice. My hope is today's discussion encourages all of us to move beyond siloed reporting and towards stronger connectivity between sustainability, finance, strategy, and of course, value creation. Because ultimately, the quality of sustainability disclosure in Asian will depend not only on the standard we adopt, but how effectively we implement them together. So thank you to ACPACC, the Asian Federation of Accountants or AFA, our speakers, moderator, organizers, and all participants who join us today. I wish everyone will have a productive discussion and meaningful exchange and takeaway from this first webinar. Thank you and have a good day.
Thank you, Professor Linda Watigani, for setting the tone for today's webinar. Ladies and gentlemen, let's move on to the next agenda. To officially open this webinar, let us hear the opening remarks from the Chair of ACPACC, who also Director of Financial Profession Development and Supervision, Ministry of Finance Republik of Indonesia, Ibu Dr. Erawati. The screen is yours, Ibu.
Thank you, Mbak Monica. Distinguished speaker, Prof. Lindawati Gani, Ibu Yuliana Sujono, Mr. Robert Charnox, Mr. Nu Queen Nanola, representative from ASEAN member states, colleagues from professional accountancy organizations, regulators, and standard setter, member of the ACPACC Task Force on Sustainability Reporting, gentlemen. Assalamualaikum warahmatullahi wabarakatuh. Good morning to all of you. It is my great pleasure as a chair of the ACPACC to welcome you to the inauguration of ACPACC Sustainability Practice Webinar. Let me start with expressing my sincere appreciation to all parties who made this session possible, particularly our colleagues from Indonesia as host, the Philippines as co-host and the moderator, Singapore for sharing practical implementation experience, and the ASEAN Secretariat, the ACPACC Secretariat, the Institute of Indonesia Chartered Accountant, ASEAN Federation of Accountants, and our ASEAN partners supporting the initiatives. Distinguished participants, today's webinar is particularly meaningful because it marks a significant milestone in ACPACC's regional sustainability journey. As we all know, sustainability is no longer a peripheral topic. Across ASEAN and globally, climate change, resource constraints, and border sustainability risks are increasingly affecting business, financial system, and economic resilience. These developments also reshape expectation for the accounting profession. In this evolving landscape, the accounting profession has an important role, not only in supporting transparency and accountability, but also in helping organizations navigate this transition with credibility, professionalism, and integrity. Recognizing this, ACPAC established the Task Force on Sustainability Reporting as a platform for regional collaboration among ASEAN member states. This initiative reflects our shared understanding while ASEAN jurisdictions may be progressing at different stages. We also face many common challenges. Ladies and gentlemen, over the past year, meaningful progress has been made through the initiative. The task force has facilitated regional dialogue, mapped the sustainability reporting landscape across ASEAN, and identified common areas where collaboration is most needed. One important takeaway is clear. ASEAN sustainability journey is diverse, but our collective progress will be stronger when supported by cooperation, knowledge sharing, and practical capacity development. This has led to several important regional initiatives, including the development of the ACPAC Sustainability Reporting Knowledge Hub and a stronger focus on capacity building activities. Today's webinar is part of that commitment. As the first session of the ACPAC Sustainability Practice webinar series, we hope this event marks a practical step toward translating regional dialogue into meaningful learning opportunities. Distinguished participants, this theme of today's webinar, connectivity to financial statement in sustainability disclosure, is both timely and relevant. As sustainability disclosure framework continue to evolve, an important question emerges. How do we ensure that sustainability related information is meaningful connect to organization border, business, and financial realities? Sustainability related risk and opportunity should not be viewed in isolation. They can increasingly shape strategic decision making, business performance, risk management, and the way organizations communicate long-term value to stakeholders. This underscores the importance of stronger connectivity between sustainability disclosure and financial reporting. Therefore, I'm pleased that today's session brings both a standard setting perspective and practical implementation experience from within our ASEAN community. I hope this discussion will provide the practical insight, encourage meaningful exchange, and help strengthen regional collaboration in this important area. Ladies and gentlemen, I believe today's webinar is not only a learning opportunity, but also an important to step in strengthening our collective regional and capability for the future. Let us continue to work together, learn from one another, and build a stronger ASEAN professional community who is ready to respond to emerging sustainability challenges and opportunities. I wish you a productive and insightful webinar. Thank you.
Thank you, Ibu Erawati, for officially opening this webinar. Before we move on to our discussion, I would like to invite you to join our group picture. To join with Ibu Era, please also welcome Professor Lindawati Gani and our speaker today, Dr. Robert, Ibu Yuliana Sujono, also our moderator, Dr. Noe, Ibu Elizarni Husin, Mas Irfan from ASEAN, from ACPAC Secretariat. Okay. On my three, ladies and gentlemen. 1, 2, and 3. 1, 2, and 3. Thank you. Before we start our discussion, let me read you the housekeeping matters. Ladies and gentlemen, presenter, panelists, and participant, please kindly keep your microphone on mute unless you're invited to speak. Participant, please post your question via Zoom chat function. And to speak, kindly refrain from using the raise hand function. Participant, please complete our post-event survey and provide your feedback to our webinar today. A link to the survey will be provided at the end of the webinar. And this webinar is recorded, and we will share the recording of this webinar on our media social platform. Without further ado, let's start our discussion today, the connectivity to financial statement in sustainability disclosure. Ladies and gentlemen, this webinar aims to explore how sustainability risks and opportunities may affect financial position, financial performance, and cash flow. Our panelist today is Ibu Yuliana Sujono, member of Indonesia Sustainability Standard Board, or DSKIAI, who also partner of PwC Indonesia, and Dr. Robert Charnock, founding director of the Metis Institute for Climate Strategy, Singapore. The session will be led by Dr. Noe Quinola, the chairman of Professional Regulatory Board of Accountancy Philippines, who also the deputy chair of ACPACC Sustainability Task Force. The first panelist to present today is Ibu Yuliana Sujono. The screen is yours.
Thank you, Monica. Good morning, honorable guests, Chair of ACPACC, who's also the Director of Financial Profession Development and Supervision Ministry of Finance, Republic of Indonesia, Ibu Erawati, Deputy Chair of ACPACC Sustainability Task Force, who's also IAI Council Member, Professor Lindawati Gani, Dr. Noe Quinanola, Chairman of the Professional Regulatory Board of Accountancy Philippines, Dr. Robert Charnock, Founding Director of the Metis Institute for Climate Strategy, Singapore, representative from ASEAN Secretariat, representatives from Accountancy Monitoring Committee Indonesia, Chairwoman of IAI Sustainability Oversight Board, Ibu Rosita Uli Sinaga, IAI Executive Director, Ibu Eli Zarni Husin, distinguished guests and valued participants, it's really a pleasure for me to be here with you today. Before I start my presentation, allow me to present or read through the disclaimer. Can you go through the next slide, please? This presentation was prepared as material for the ACPACC Sustainability Practice webinar, Connecting Sustainability Disclosures with Financial Statement, on May 29, 2026. The presentation delivered at this event does not represent the position of IAI. The position of IAI is determined only after going through the due process procedures and deliberation process as required by IAI. This presentation provides a general overview and is not intended to present the entire standard in detail. IAI is not responsible for any losses that may be incurred by parties acting or delaying action based on the information in this presentation, whether directly or indirectly, including those caused by negligence or other factors. Ladies and gentlemen, as you might all already aware of, the World Economic Forum has recently released the Global Risk Report for 2026. And I think still consistent with the risk report issued in 2025 and before, extreme weather events has always been identified as a global top risk. If you look at the chart showing on the right-hand side, the colorful one, the left table showing the short-term risks less than 2 years, and the right-hand side table showing the long-term risk, which will happen longer than 10 years. So if you look at this chart, extreme weather for short term falls under top four global risks. And for long-term risk, extreme weather, biodiversity, critical change to Earth systems, and environmental related risks has dominated the long-term global risks. So in Indonesia itself, when we look at several plantations report, palm oil plantations in particular, I noticed that there are declining productions, in the past few years, and reported the reason behind such shortfall is because of the uncertain climate or uncertain weather in Indonesia. So that shows how climate issues can relate to production and then eventually to the revenue and to the performance of the company. So we try to give you an insight of what climate issues usually covered. And it usually covered two aspects. First is the physical risk, and the second one is the transition risk. Physical risk being the natural related events, for example, floods, heat waves, and droughts. We have experienced floods in ASEAN countries and in Indonesia in particular in late 2025 and also 2026 has caused a landslide in the northern part of Sumatra, which then creates business disruptions for many companies located in the northern part of Sumatra. And that also creates supply chain disruptions, asset damage, and also business interruption. And on transition risks, basically those risks are relating to the policies issued by countries to when countries try to limit the exposure of physical risks for that region. And usually the country or government will issue policies supporting the environmental, for example, carbon tax and also carbon pricing related policies. And also the issuance or adoption of new technology that is more efficient in the energy consumption. Also on the market transition, market demands, changes in market demands as well. For example, the where the market is now transition towards the consumption of renewable energies to support the resiliencies of the operations itself, looking at the geopolitical conflict that we experienced lately. Now, examples of future carbon tax will definitely increase the operational costs of a company. And aside from the government-related policies, we also see international organizations. For example, the IMO, International Maritime Organizations, has issued policies regulating vessels shipping in the international sea, which has exceeding certain emission quota. And for vessels that has exceeded the emissions, then carbon price or additional carbon price need to be made for the shipment. And that additional cost will then, of course, increase the production cost, the logistic cost, and eventually will decline or reduce the company's financial performance in the future. To the next slide, please. And with that condition, with that event, investors wants to understand more how companies are adapting to such climate events. because the conditions, for example, the landslides that happens in Indonesia early this year, affecting the license to operate of companies located in those areas. In this example, Indonesia sues 6 companies over the environmental harm for that event. And we also see in the news whereby Asian companies face annual costs to mitigate the climate risk by 2030. So investors starting to see, go to the next slide, please. Investors starting to see sustainability as the new currency. The investment decision is not just looking at the traditional financial ratios, but now investors starting to incorporate sustainability related aspects into their due diligence checklist, into their investment decision. Same with capital providers, for example, financial institution. We also see the development in ASEAN countries in particular, whereby financial institutions are encouraged by the regulators and have proactively included the sustainability related risks and opportunities in their loan acquisition process. Therefore, the quality and connectivity of information, of your sustainable information, would be critical to give confidence for the investor upon investing to your company and create trust. Also, to show the credibility of the directors, of the executives, and provide informations to the investor that the directors are fully aware of the conditions and are taking actions toward it. And what investors would like to see is that how companies link the sustainability risks, in particular those relating to climate, like drought, fire, and nature related, the nature degradation, and also social aspect, and how it will then affect the operational or strategic decision of the company. Let me give you an example of FMCG, whereby this FMCG has high dependency on raw materials coming from plantations companies, and they have a concentration of supplier in one certain location, whereby this location has highlighted as a high risk to fire because of El Nino in the near future. And what might happen, because they do not have suppliers coming from other locations, and when it is fire and in a very dry condition, fire will easily spread throughout that location. So if you only have suppliers located in nearby locations, then you might experience supply chain disruptions, which will then have financial consequences, will have disruption to your operation, and will affect your revenue target achievement. You might need to then switch to suppliers from other locations, but that might also have cost implications, for example, increasing logistic costs. Those items are the informations that investors trying to understand if they invest in a company that has not considered these aspects. How would then it affect the ROI of the investment put into the company? Similar with financial institution, when they give fund to or loan to the company, they wanted to make sure that the company would be able to pay back the loan. But absence of doing such assessment will create high risk of NPL, non-performing loan for the bank. And therefore, the bank might adjust the pricing accordingly, or the tenor of the finance or the funding later on. So those are the aspects that investor and financial institutions try to understand before they put investment or provide funding to companies. To the next slide, please. And therefore, IFRS is trying to address the investors and financial institutions' needs by issuing the IFRS S1 and S2. IFRS S1 itself consists of conceptual foundations of the sustainability disclosure standards and also general requirements. And amongst other, they also required 4 core content for the disclosures covering governance, strategy, risk management, metrics, and targets. I'd like to highlight a bit on the conceptual foundation, whereby the requirement is that fair presentation in the disclosure. Companies need to present the relevant information that is material for the users of the financial information, including completeness of the material information that need to be understood by the user of the sustainability reporting user. And then for materiality, IFRS S1 also adopting the same concept of materiality with the financial statements. So concept here doesn't mean that IFRS S1 adopting the same benchmark or imposing certain certain numerous benchmark. But what IFRS S1 adopting here for the materiality would be the same concept whereby if the information is omitted, then it will provide misleading information to the user of the sustainability report. And then on the reporting entity itself, I think this is also quite different with the previous sustainability disclosure standards that has been adopted by companies in ASEAN. Whereby in the old reporting, there is no specific requirement on the reporting entity or the some companies still can choose subsidiaries within the entity, can select 1 or 2 subsidiaries to be reported under the sustainability report. But IFRS S1 and S2 required the same reporting entity with the financial statements. And also connected information, like what Bu Linda mentioned earlier, that the sustainability reporting need to have a connected information with the financial statements. And on general requirements, I'd like to highlight on the reporting timing, the timing of the reporting of the sustainability disclosure. Usually, in particular in Indonesia, certain entity are still able to disclose the sustainability report far after the financial report is submitted. However, under IFRS S1, the reporting timing has to be the same with the issuance of the financial statements. Also, the requirement to show the comparative information stated in the IFRS S1 and statement of compliance for the disclosures that has complied with all the requirement under IFRS S1 need to be mentioned explicitly in your sustainability report. Also on IFRS S2, IFRS try to zoom in on the climate-related aspect and the effective date and transition relief also mentioned in the IFRS S1 and S2. Go to the next slide, please. Now we try to zoom in on the connected information. So financial statements and sustainability related financial disclosures need to have similar boundaries on the reporting entities as I mentioned before. Then on the reporting period, the financial statements need to also have the same reporting period with your sustainability related financial disclosures. And on timing of reporting, you also have to submit the sustainability report at the same time when you issue your financial statements if you implemented IFRS in your sustainability disclosures. And for the currency, you have to also use the same currency as the financial statements. Also, data and assumptions, you have to adopt this same, to the extent possible, the same data and assumptions as the financial statements. So with that, the objective of the financial statements and the objective of sustainability report, whereby to provide information that is material for decision making, will be linked together. To the next slide, please. And if we try to zoom in a bit on the topic that is creating a lot of questions from our Indonesian implementers, are the connection to the financial effect and the sustainability disclosure. So here, the IFRS requirement is to connect the financial effect for the financial statement at the current reporting period, next annual reporting period, and over the short, medium, and long term as well. So let me try to zoom in on the effect of the financial effect on the current reporting period. For example, if there is a regulation issued by the government, say they prohibit the use of gas-powered water heaters because of emissions at a future date, for example, then the financial effect for companies that use water heaters would be impairment loss or accelerated depreciation over the water heaters if the certain date has been explicitly announced at the regulations. And in your sustainability related financial disclosures, what you need to do is to show the qualitative reason, and then also showing the quantitative implication for connecting the sustainability related risks and opportunity to the impairment loss that you have already adjusted in your financial statements and disclosed in your financial statements. So a reference from your sustainability report to your financial statements is needed. To the next slide, please. And for the future financial effects, next slide, please. Yeah, this one. For the next annual reporting period, example on the fire forest risk. This is typical of the physical risk that has uncertainty on the frequency and also severity. But there is a significant exposure would be experienced by company on the carrying amount of the assets when this event happens. So what the financial effects would be, you need to consider the assessment into your impairment analysis, even though because of the uncertainty in the frequency and also in the severity, you might need to not to adjust on the impairment loss over the next annual reporting period. However, for your sustainability related financial disclosure, you need to disclose it as the qualitative disclosures in your sustainability report. And for quantitative information, you can give a range of the carrying amount of the assets when such event happen. To the next slide, please. And this one, the anticipated financial effect, whereby company need to show the implication of sustainability related strategy decided by the board of management over your short, medium, and also long term financial effects. For example, a company that decided to have a 5-year transition plan to change their fossil fuel based vehicle to EV-based vehicle. So in the current financial statements, the company might not require to adjust any numbers because of this decision, because no no EV has been acquired, for example, yeah, in this case. But then for your anticipated financial statements, then the company need to show the quantitative information, for example, regarding the capital expenditure per year that the company need to spend to adopt to this strategy. And also the potential charging points that the company need to establish because of this strategy. And last but not least, also on the opportunities regarding the reduction in fuel costs because of this adoption. And qualitative information also need to be shown regarding the how are you going to get the funding for this capital expenditure going forward. To the next slide, please. And in Indonesia, Bapak Ibu, ladies and gentlemen, IAI as early as in December 2020 has established a task force for comprehensive corporate reporting and establish the Dewan Standard Keberlanjutan, the Sustainability Standard Board, and also Sustainability Standard Monitoring Board by November 2023. And a year after that, IAI issued the draft SPK adopting the IFRS S1 and S2. To the next slide, please. And the exposure draft has been finalized in July 2025, as shown in the next slide. Can you show the next slide, please? Yep. In July 2025, the SKIAI has ratified the PSPK 1 and PSPK 2, which is in alignment with IFRS S1 and S2. And currently, the Indonesian FSA, OJK, is drafting new regulations on the adoption of this PSPK 1 and PSPK 2, which will be released in the near future. To the next slide, please. This is the main differences between IFRS S1 and S2 and PSPK 1 and PSPK 2 issued by the SKIAI. On the effective date, IFRS S1 and S2 starting from 1st January 2024, whereby PSPK 1 and PSPK 2 effective date is started on 1st January 2027 with early adoption. And adoption on climate first, similar with IFRS S1 and S2, we provide the relief for the adoption of climate first. However, the difference with IFRS S1 and S2 is that the adoption for climate first relief under IFRS S1 and S2 is only for the first year, while for PSPK 1 and PSPK 2, we give 3 years relief for the adoption of the climate first, which is the IFRS S2 with foundational requirement under the IFRS S1. And then for the financial emission classification under IFRS S1 and S2, have to follow GICS, while for PSPK 1 and PSPK 2, for the ease of the adoption in Indonesia, we follow the classification which has been determined by the Indonesian regulators. And for the use of GHG protocol and scope 3, we provide the relief for 3 years as opposed to the 1 year relief as provided by IFRS S1 and S2. And for the timing of disclosures, there's also a different, whereby IFRS S1 and S2, the timing of disclosure of your sustainability report has to be at the same time as the release of the financial statements, whereby for PSPK 1 and PSPK 2, we provide relief at the latest when the annual report is published in accordance with the applicable law in Indonesia. And then the locations for disclosure is similar with IFRS S1 and S2, which is as part of your general purpose financial reports. With that, I end my presentation and hand it over back to the moderator.
Thank you, Ibu Yuliana Sujono, for your presentation. Next, we will have Dr. Robert Charnock, Founding Director of the Metis Institute for Climate Strategy Singapore, to present your presentation.
Thank you very much, and thank you for the invitation to join the webinar today. I think the comments that have already been made frame this perfectly, and Juliana's comments there in the slide deck. It presents this very clearly what the standards are requiring, but also the context about why this has happened. Not just here, but across the entire world as well. And what I'd like to do with this time I have with you is dig into a lot of examples of how this is done within organizations. So I'm not really going to talk too much about the level of the standards or the disclosures themselves, but how you calculate those financial effects internally. I'm going to do this using examples from client projects that have been anonymized and some examples from the market as well of what good disclosures might look like towards the end. But yes, I'm Dr. Robert Charnock, or Rob. I run the Metis Institute in Singapore, and my background is primarily in climate finance. So my PhD is in climate finance, and I've been working on climate risk now for about 15 years, so maybe a bit too long, some might think, but still this means it is my favorite topic. But before I get into calculating those financial effects, this is the diagram we normally use at Metis to explain the workflow involved in a climate first or S2 approach to climate disclosures. At the start, you'll see the first 3 boxes are really about laying the correct foundations within your organization. And if you're not familiar with the term proportionality yet, I do recommend you spend a lot of time on proportionality, because this basically is there to help you. It's designed as a way of narrowing the scope of your work based on the resources and the skills that you have available. So proportionality is meant to be a very helpful way to narrow the scope of work while you build that capability. I would typically break this disclosure into 2 parts, then 2 different work streams. One that's focused on the carbon accounting side, the scope 1, 2, and 3 calculations, and a second work stream that's more focused on climate risk and the financial effects of those risks as well. Obviously, there are some financial effects from the carbon accounting, but still the financial impact assessment I'll talk about today is primarily linked to risk. Once you've completed those 2 work streams, you then really can start bringing it together in the final few steps, setting those metrics and targets, getting the board's support for the decisions that need to be made, coming up with a plan. Juliana's already talked about if you have transition plans about certain changes that need to be made that might require CapEx, for example. That's what provides you with the information that you need in the disclosure. And what I'm going to do is use this based on the training that we deliver at ISCA, so the Institute of Singapore Chartered Accountants, of course. This is a 3-day program, and I'm just going to use a very small segment of that to illustrate the financial effects component. So like I say, normally we'd take 3 days, and I'm not going to try and do 3 days in 25 minutes now. But even so, I think this should give you a fair sense of what's expected and what's involved, even if there's still some work to do afterwards. Now, we've already heard most of this today. This is really just here for your reference. The slides, I've said the slides can be shared afterwards as well, so you should receive these. But as you'd expect, there's a wide range of different financial effects that could arise from this. This has already been covered reasonably well, and I think is probably the most familiar to the audience we have today. So that's why I'd actually just move straight from this and talk about what we're trying to get to. What are we trying to achieve by the end of this? So where we're trying to get towards is a clear disclosure, not only about those anticipated financial effects that are coming in the short, medium, or long term, but very much what are the current effects as well. So while a lot of the risks that you talk about and a lot of the changes you talk about might be in the future, because that's the purpose of this exercise primarily, there will also be impacts in the current financial year. And that gives you really an important baseline for what you're measuring. If there are no current effects, then obviously there can be gaps. And you'll see in the short, medium, and long term of this example from the ISCA Illustrative Sustainability Report, there are plenty of notes that are provided. Essentially, these notes are explaining why certain things are not quantifiable at present. Now, I'm fortunate that I speak to the ISSB about how their training is going, about how they're trying to educate the market quite regularly. And the key message that they reiterate to me is, from the ISSB point of view, a good disclosure is one that communicates the journey that the company is on. They're not looking for perfection every single year to begin with. They're looking for a disclosure that communicates what you can do, what you've done well, and that you know your gaps. You can identify the gaps that you have and that you know how to address those gaps. So, for example, the notes provided here, if you look into the illustrative report, are talking about what is not quantifiable at present and why, and at what point different things might become quantifiable as systems develop, and also as new data sets become available in public as well. So there will be gaps, and it's important to recognize those gaps and communicate how you will address them over a certain time period. But to the core of what I want to talk about, that's where we're trying to get to. The question is, how do we get there? So I'm going to show you some client examples, and my intention here is not to intimidate you, not to scare you. It's just to show you what this looks like internally. And typically the spreadsheets might not be the most beautiful thing, but this is one of the simpler spreadsheets, believe it or not. This is just a snapshot, by the way, a small screenshot of the spreadsheet. The real spreadsheet had about 27 columns, I believe, and 400 or more different rows for each individual risk. Now, this is the output of climate scenario analysis, which is really going to be the backbone of your risk assessment. Because we're talking about financial effects, I'm really today wanting to talk about what we do with this. Once you have a spreadsheet like this, what do you do? I realize for lots of people on the call, this spreadsheet might look terrifying or at least a bit intimidating. It did to me when I first came across this about 6 years ago, where I really saw these spreadsheets in detail. But the point is, there's a whole well-developed method for how you progress this. There's various training that's available for how to do it. Typically, I would say it takes a day to be trained to know how to go about this, but you would still know some of the areas where you may require some external support. If you have questions about this, feel free to drop me a message on LinkedIn or via email. But really what I'd like to do is move on to say, once you've identified your key risks, what do you do? So even though this spreadsheet example here had more than 400 rows, each row representing a different risk that we analyzed, in the end, we only did a deeper dive on about 30 to 40 individual risks, because that's the idea here. You do this risk assessment to prioritize your further work, and you prioritize those risks that score high. So if you have risks scoring at the top of the ranking, risks coming up towards the top as well, you then dig a bit deeper into the financial effects behind those. So if you think you have a spreadsheet of 400 risks, you then maybe are taking, in my experience, anywhere from about 10 to 15% of those risks as the priority areas deserving more attention. Because what we want to do with those risks is to turn them into, again, something like this. Now, this is another example. The consultancy in Australia that we sometimes work with is Edge Impact. And so this is an anonymized version of one of their client outputs. Again, breaks the different impacts down into OPEX and CAPEX impacts over different scenarios and different time horizons as well. So you see, there's quite a bit of work to do to get here. And again, what I'm interested in doing is showing you how to do that connection. Because to me, one of the hardest parts, and I think Juliana commented on this as well, one of the hardest parts people are seeing at the moment is how do you convert the scientific findings about your risk exposure into financial figures? And this is why I need to introduce you to a core term. The core term is impact pathways. Because what you will see when I present the risk register I had before with 400 different rows, the descriptions of those risks give very high level financial implications. Okay, the definitions are clear, but it doesn't really give you the detail of what that financial effect is going to be. Impact pathways take that a step further. So the risk register is fine, but it needs to be extended into an impact pathway that shows how and why value will be affected by each of those risks. And there can be different reasons for each, and sometimes there will be multiple reasons for each individual risk as well. So the idea is that what these impact pathways are going to show you is how you should understand the financial impacts of your risk exposure. And when I say risk exposure, I do mean opportunity exposure as well here, by the way. So whenever I'm talking about risks, it goes hand in hand that opportunities are also part of this story. There is some method out there for impact pathways. One of the reasons why this was such a problem in 2025, though, is because there's not much guidance on how to do it. There's not really a clear standard. The best that I've seen in the market is produced by WBCSD, and that's what I used for this slide here. And this is the overarching logic behind an impact pathway. You start with the risks and the outcomes that I showed you in the risk register. But you take those a step further. So for example, the instance that's used in this diagram is saying that if you need to close unabated gas plants, well, they'll need to be decommissioned, and they'll need to be decommissioned ahead of the expected date. Obviously, that's talking about a change in their useful life. So, and there are different business impacts here. And this is my point that any one risk could have multiple pathways to financial value impact. You could have closure of operations, change of economic and useful life, closure of sites, redundancies and layoffs, and so on. Each of these has a different financial impact: revenue, asset impairment, increased costs. Each of those will also feed through to the financial statements in different ways. So the main point I'm making is these impact pathways are about taking each risk that you have prioritized, not each risk, not all 400 that I showed in that spreadsheet, but the subset of 10 to 15% that scored the highest, and work through the business impacts and corresponding financial impacts of each. Once you have this, you can then start developing your input equations. So first off, this diagram is the impact pathway. So what is the pathway towards an impact on financial value? Here we're talking about input equations. In other words, if you take one example, so this is a client example that finished in November last year, so a few months ago. The client had about 36 different, here we go, 35 different equations that we developed, and that covered about 10 aggregate level risks overall. One example, the simplest example from that client project, was this: the problems and disruptions in the supply of goods or services stemming from physical hazards. Okay, so this will cover a few different avenues, a few different impact pathways, and for each one we're going to write an equation. The first impact after the workshop with the client, again, this has to be a lot of human judgment within the company. So we work with the company and their internal stakeholders to say what would be the financial value impacts. First off, they highlighted increased costs because of expedited shipping requirements, increased inventory holding, and penalties due to delayed shipment. So you see, this is not rocket science, I wouldn't say. This is very normal for an accountant. I think very normal for people who work in an accounting or finance function to see that there will be costs due to some change in the external environment. The point is, it becomes the job of the finance team typically to work on these input equations. How are you going to calculate those financial effects? Now, we have 3 example input equations, and I say proposed because in our experience, you have to propose these to the internal stakeholders. If you try to do this yourself, just at your desk and do all the calculations, you may get some very interesting numbers, but there will be a lot of pushback from your colleagues about how each was calculated. Of course there will. So we always talk about proposed input equations because we will run a workshop covering all of these equations to get approval from internal stakeholders before we do the work. Because there's quite a bit of work involved in gathering the data that you need to begin with. And if we're talking about challenges of getting this done, data collection is a major challenge. And I'll show you why. I think it's on the next slide. But if you look at these input equations, I don't think these equations should scare anybody. Maybe I'm calling them equations and that sounds intimidating, but really we're talking about how many additional shipments do we need per year and what is the additional cost, or what is the cost per shipment? This is very much going back to sort of university day levels of textbook-based calculations. So these are relatively straightforward. The more challenging thing is how you gather the data for this. So if we look at that, this is the client data request that we issued. For example, the same equations on the previous slide. And essentially, there are two different sources of data, and that's part of the issue. The company has a lot of that information. Okay, the company has a lot of raw data about their current operations, about the current costs that they're facing, but the company does not have any data about what the trends are likely to be in energy pricing necessarily. They may not have trends about the industry benchmarks or the market rates for new elements of their operations. So what you're having to do at this point is approach your internal stakeholders for data where it belongs in-house, whatever it's needed for those equations. And that's a major data request form that you send to colleagues. These are quite significant pieces of work, to be honest. And if the process takes a long time, it's because it takes colleagues quite a long time to respond to those data requests, to be honest. But then the externally sourced data is typically the job of the risk assessment team. They would be going out to find the research or the government documents, anything that's in the public domain that gives you evidence for certain impacts on logistics, certain market rates, certain industry benchmarks as well. The idea is that once you've gathered all of these different data points, you can complete the equations that were on the previous slide. So when we think about this, like I say, the rocket science here isn't really a thing. The equations are relatively straightforward. The very challenging thing is identifying your data requirements and securing that data either internally or externally. So the biggest problem or the biggest time commitment here is often gathering the data itself. Of course, developing the core risk register that I showed at the start of the talk is quite time consuming, but this is the most time consuming part of calculating the financial effects. And if you think, so once you've got that data and you can calculate the impacts, what does good look like? What are we seeing in the market, if you like, as good examples of practice? Well, there are quite a few examples that are out there. I would say Brambles, which is an Australian organization that works in sustainable packaging and sustainable pallets. They've got some very useful disclosures that are quite detailed. They will, for example, they'll break down the opportunities side. Now, one of the main problems I see in the market and with clients is that the disclosures will be very risk focused. And that's fine. That has been the focus of the last 10 years since the Paris Agreement and since the launch of TCFD, of course. But the opportunity side is vital, and most organizations ignore it. Maybe just, I don't know why that is, but risk seems to dominate the conversation. Brambles, though, do calculate those climate-related opportunities. And again, there's very good guidance from WBCSD on calculating those opportunities. In addition, and aligned with Juliana's talk previously as well, the capital deployed that's required for the different responses to those risks and opportunity is outlined. In addition to that, they've also got quite detailed footnotes. If you look in the bottom left of this slide, the footnotes that really explain a lot of the workings behind these disclosures too. So the point is, Brambles have a very clear, detailed breakdown around impacts on financial position, the opportunities, the capital requirements that are coming through as well. The point being, the core aspect of S1 and S2 is to communicate the impact of climate change and other material sustainable issues on the entity's financial position. And this is a reasonably detailed breakdown. Now, the challenge companies normally have when they write their disclosure is that, how to say, they don't want to disclose commercially sensitive information. They don't want to disclose anything that gives them a competitive advantage, and any insights they have that they don't want to give away to their competition as well. So typically you'll see the disclosures here will be a bit more high level than the internal documents, definitely, by far. But still, it gives a relatively clear view of the trends in the impacts on the financial position of the entity. Another example, and actually this example is from a couple of years ago, but I do like to bring it in because it's an example to me of a good early disclosure. So if you think about the example I gave from brambles, that to me is the example of what a disclosure might look like after 2 years if you've been working very hard, or 3 years if you've been going at a more normal pace. Keppel's disclosure here, to me, is a good example of when a company first tries to calculate the financial impacts. This isn't always done in the first year. It depends on your proportionality decisions, like I've said previously. But Keppel here, I would say the granular breakdown that you saw with brambles doesn't exist. But that said, Keppel is still providing a lot of detailed information. They're talking about the asset value that is assessed to have high vulnerability to risks, and they're being transparent. The total asset value is 4.9 billion at that point in time, with 4.3 billion of those assets assessed to have high vulnerability. Keppel also then go on to talk about the different pathways that they've been assessing and the different ranges that are involved. Now, when I'm delivering training like this over the course of 3 days, one question that I normally get is, why are people using ranges here? And ISSB are very clear on this. Using a range for anticipated financial effects is absolutely plausible because we're dealing with the future. And the future is always going to be uncertain because it has not happened yet. We don't know. And because of that uncertainty, often a range is the most accurate representation. So the point is, use a range when it's the most accurate representation of your analysis. And for the future, it will normally be a case of talking about alternate scenarios, alternate pathways, or a best case and a worst case. So in that sense, ranges are very much expected. And at this point, talking about ranges, I want to say one thing that I always say on this. Companies want to be as precise as possible when they look at their risks and when they look at their financial exposure to those risks. Now, there's no huge problem with wanting to be precise and accurate, but remember, we're dealing with the future. We cannot be precise because it is the future. It is uncertain. So one of the sayings about this work is it's very easy to go from being roughly right to precisely wrong. In other words, roughly right is the goal for this work because it's dealing with the future. If you try to make it really precise, it'll almost always be wrong because it's about the future. So in other words, roughly right, talking about ranges, that is the best practice here, and it's the best reflection of reality. Now, this isn't the only example, of course. That's just Keppel is more an example of an early stage disclosure where a company is disclosing financial impacts for the first time. I think the other example that's often brought up, especially by our Australian colleagues that we work with, is BHP. What I think's been really interesting is BHP under climate change will have quite a detailed breakdown about the impacts on different aspects of the financial statement. Okay, so climate change here, it's a very brief disclosure that I've snapshotted, but again, it's clear. And it's that clarity that's so powerful, I think, in this disclosure. It talks about what the climate change strategy focuses on and the financial statement areas that could be affected. This is very much aligned with S2 and the principles behind the ISSB standards. It's about the financial impact on the financial position. So there's a lot of detail that's provided. I think what's really interesting, though, as well, is they're covering not only the physical, but also the transition risk. Of course, it has to be done. But it's explaining some of the logic behind the impact of transition risk, say, on carrying values. It then moves to provide more detail on the useful economic lives of plant and so on. So it's really providing quite granular, quite detailed information on how these higher level risks that we saw in the risk register feed through into impacting those core assumptions underpinning economic lives, for example. Even so, they'll provide a reflection. So, for example, even though this is the case, the group's decarbonisation plans have not had a material impact, is the conclusion that that's led to. Now, I've mostly talked about risk, but one thing I like about this BHP example is they also provide quite clear information about carbon accounting. Obviously, I've focused a lot on risk, the risk register, the financial impact of those risks. But if you're going to decarbonize your scope 3 emissions, that is less a part of your detailed risk assessment that you do, and much more about saying we have a target to reduce our emissions, we need to reduce our scope 3 emissions, and we are going to have quite a significant budget, whether that's research and development budget or capital expenditure, partnerships, and so on. And so in this sense, what's great about this BHP example is that it starts talking about bringing the risk side and the carbon accounting side together. But one thing that you'll notice about this BHP example is the quantification piece is quite limited. So actually, there's quite a lot of granular information that is available from a qualitative point of view, but it doesn't have the same level of sophistication for a quantitative analysis. And so this is another thing I like to reiterate to people. Quantitative is the aim for a very mature assessment and very mature approach. Absolutely. That does not imply qualitative is bad. Qualitative work is essential for building capability, and qualitative disclosures can be very high quality as well, can be very granular, very detailed. They just don't include the financial figures. So it's not as easy to say as qualitative is straightforward and easy and the worst, and quantitative is much stronger. You need to make sure you take the qualitative approach seriously while you build capability. And that way, when you start on your quantitative work, you'll be in a much stronger position as well, and you'll understand what good disclosures look like too. So again, I just want to come back to this diagram because I think when people look at S2, it just looks like a standard. It doesn't look like workflow. And I prefer to think about a workflow. Now, this is not a perfect model, okay? This is something that we use to teach people how to think through that logic, what the teams need to do at different moments in time. So if this is helpful for you, great. I don't think it's perfect. Everybody that I speak to, I say, you will need to adjust this for your own organization. And it has to be integrated with your other systems as well, of course. That said, if this is useful just to think about a general approach to an S2 disclosure and how to bring those financial effects clearly through from detailed scientific assessment all the way through to the financial figures being calculated through impact pathways and input equations, then great. And remember, at the end of the day, the disclosure piece here should tie together both sides, the carbon accounting and the net zero targets, together with the risk assessments, the opportunities, and how your business model will remain resilient going into the future as well. So there's really two core parts of this climate-related disclosure, and they have to be brought together at the end. Now, there's a lot more I could say. Typically, I take 3 days over the detailed work on S2, but for now, I'll just say thank you. I'm very happy to answer questions during the session after this. But also, if you've got any very specific questions that you want to raise, if you scan the QR code, you can connect with me on LinkedIn and message there. Otherwise, my email address is on this slide as well. So as a former academic, I'm obliged to say my door is always open, so please drop me a message whenever you want with any questions. But with that, I'll hand back to the moderator and thank you very much for your time and thank you for joining the webinar today.
Thank you very much, Dr. Robert, for your presentation. And now we are on Q&A session. I would like to invite our moderator, Dr. Noe Guinanola, Deputy Chair of ACPACC Sustainability Task Force, who also Chairman of Professional Regulatory Board of Accountancy Philippines. To Dr. Noe, the screen is yours.
Okay, thank you. Thank you, Monica. Am I audible there? Can you hear me?
Yeah, we can
Okay,
hear you.
good. Yeah, first, I would like to congratulate Madam Juliana Sojuno and, of course, Dr. Robert Charnock for a very informative presentation. You know, so we have been talking about sustainability for quite some time, and this has to be disseminated to everyone. And I think this is the first step. And I hope that there will be more activities like this in the future. Okay, for the question and answer portion, um, we have something like 560 participants in this Zoom meeting. So if you have some questions, I think it would be proper to put them on the chat box so that we will We will just let the speaker, or the two speakers, in fact, answer your questions. Okay. Now, let me start with some basic questions about sustainability reporting. The thing is, sustainability, like climate change, is not the domain of preparers of financial statements. Okay, so accountants alone cannot do that, right? This is actually to be a concerted effort of a lot of professionals, environmentalists, engineers, and all those things. So, how is the capability building? Uh, you know, Capability building for the financial statement preparers being handled in your respective jurisdictions. And just actually would like to be informed about Indonesia and Singapore so that we will not go around the table, okay? And then perhaps the other member states can assess their own implementation of this sustainability reporting of where they are right now. Okay, so how is it being conducted, or how is it being planned to be conducted if it's not yet conducted? We can start with Madam Sujono.
Thank you, Dr. Noy. So in Indonesia, we are trying to embed sustainability into the university curriculum as well, in particular for accounting major. It's still at the starting points, but in the practice, how I see organizations trying to adopt IFRS S1 and S2 is that they form a task force consisting of multidisciplinary functions, like, for example, finance, sustainability, marketing, operations, and business. They sit down together, including risk management as well. They sit down together and see how this will finally affect the whole organizations, because you are very right. I don't think finance alone or sustainability team alone would be able to draft such requirement as mandated by the new standards.
Thank you, Madam Sujono. What about Dr. Charnock?
I think you're absolutely right. This is when I speak to finance teams and they're in the room during the first workshops. Typically, there'll be a finance director or a CFO, and they'll have their arms crossed, leaning back in their chair, saying, I don't know anything about this. This isn't my field. I shouldn't be here. They're very uncomfortable because this is dealing with the climate science first, and it feels like this is completely different. More than that, it feels like the quality of the data, the quality of the accounting is so weak in comparison to financial accounting. So there are many reasons why the finance team are anxious about this, why it's very unfamiliar. But the point I always make is the finance team has to be there from the start because they have a lot to learn to begin with. And by the time they've learnt it, they can then apply their own standards to that interdisciplinary group. The sustainability team may be part of the conversation, but they may have not been held to the standards of the finance team previously. So I think it's really important for the finance function to apply their quality judgment, their quality expectations to this process. But before they do that, they have to understand the process too. In terms of Singapore's been good at giving very clear instructions to the market about the timeframes for implementation. And I think Singapore's unusual in how it approaches training. There is a lot of training available in the market of varying quality, but what Singapore's ACRA have announced last year is something called the SRBOC. The acronyms are everywhere here, and SRBOC stands for the Sustainability Reporting Book of Knowledge. It's incredibly useful, and it essentially says if you're running a training program, these are all of the topics you have to cover and the amount of time to be spent on each topic in order to be compliant. The point I'm getting to is not just that it's a good standard. If you are compliant, there are subsidies available for the training as well. And so I do think that's a big part. Making subsidies available for low quality training is problematic. But if you can require training to be addressing the more challenging aspects of the standards, then yeah, subsidies being made available are key. I think, though, what I'd just emphasize is clear messaging that it's the responsibility of directors to get up to speed. and then making sure that there's proper training being delivered, whether it's through the professions or through the universities, whoever is a legitimate, credible provider as well.
Yeah. Yes, I agree. This cannot be done by finance alone. Finance is not so equipped to complete the process. That's why finance people should also understand that this should be a cross-functional team effort, multidisciplinary, so that everything can be captured and all the information will be in the disclosure. Okay, the other question I have here is, what is the extent of implementation of sustainability reporting in your jurisdiction? Like, for example, is this required now for all companies or for selected companies? And, perhaps why? Is it only for selected companies, if that is so? Yeah,
I think I can start
Madam,
first.
John, okay.
Yeah, thank you. I think I
Ladies
just want to
first.
add up. I just want to add on Dr. Robert's explanation before. I think similar to Accra here, EIE also provide similar trainings, and in fact, OJK understand the knowledge gap and the upskilling requirement. Therefore, EIE is there to help out on the upskilling. And in fact, last Tuesday we just had because EIE is quite active providing socialization on the upskilling, so we have an executive sharing sessions on the implementation of PSPK 1 and 2 together with IDX and OJK. So linked to your second questions, in that session, OJK also announced the adoptions requirement for Indonesia, whereby OJK split the group into 3 groups. The first group will then need to apply the PSPK 1 and 2 by 2027. And those falls under first group would be large bank, falls under KBMI 3 and 4. Those are large banks. And also the second one would be listed entities under the main board, and development board also falls under the first group who needs to adopt the PSPK 1 and 2 by 2027. And interestingly, OJK also requiring the limited verification over the disclosures of the sustainability reporting by 2029 for the first group. So first groups will effectively adopt the standard in 2027 and get the disclosures to be, they call it the limited verification by 2029, in particular for the GHG disclosure and governance disclosure, and also the Indonesian taxonomy classification, which is required to be adopted in the sustainability reporting. Then the second group will then need to adopt by 2028 and get it assured by 2030. And the third group will need to adopt it by the 2030 and get it assured 2 years later. So that's the plan adoption in Indonesia.
Okay, thank you. What about in Singapore, Dr. Charna?
I'd say a very similar rollout, and it's staggered over time, of course. So SGX have communicated quite a clear roadmap for when compliance is required, when assurance is required, depending on sector, depending on group, depending on company size as well, and then going beyond SGX as well, where it's looking at large private interest, large entities of public interest. So it's very similar, and I would also say it's similar across most jurisdictions that there's this gradual rollout. There is one thing I want to comment on specifically. First, if you want the details, the SGX website has it very clearly communicated. The second piece is SGX delayed their implementation. So they announced an original timeline and then pushed that back. Now, what was really important is the messaging that came with that from SGX, which was saying that this isn't delaying it because we don't think it's important. We've delayed that roadmap because we've realized how much capacity building needs to take place, not just among preparers, but also in the audit market as well. Audit firms having to get ready to be able to audit a lot of these disclosures too. So in that regard, the message from SGX was clear. This is not saying you can pause your preparation work. This is saying you still need to continue as planned, but it's probably going to take you a year-ish longer than we thought to be ready. So I think that was really important because otherwise it would look like you could just hit pause for a year and revisit the conversation a year later. But that was completely the wrong interpretation if that happened. And I think that's been quite common in many jurisdictions as well, to see that the level of work involved to learn these standards, to learn the practices is important. And just that now coming back to your comment about this isn't purely about finance and it's about all different groups. When I often talk to people about the first year of reporting, it's not going to be perfect by a long
Yes.
shot. In fact, one of the things that you will learn at the end of the first year is who you should speak to internally. There is a high probability that in the first year you've been speaking to the wrong people internally, and that in year two you'll actually speak to the right people internally. That's the type of learning that we're talking about. It's very human at times.
Yeah. Anyway, okay, yeah. I think if I will, an observation from all other Asian member states, just like in the Philippines. In the Philippines, right now, it is being adopted or required for publicly listed companies. But soon it will be, going down to, it will trickle down to all corporations for that matter. Now, yeah, so like in Indonesia or in Singapore or in the Philippines or anywhere else, there's a schedule on when companies will be adopting or required to. And I suppose that's covered by a law, right? Or a directive from the regulators. Is there any consequence of not following it or not reporting it? Like a penalty or whatever? Yes. Yeah. Madam Sejona, please.
Yeah, so in the draft regulations, the OJK mentioned that the failure to submit on time will be imposed, a penalty will be imposed for the late submissions. And interestingly, not just late submissions, but OJK also mentioned in the new regulation, in the new draft regulations, that errors in the information presented under the sustainability report will be also exposed to penalties as well. So I think OJK understand how the sustainability report is importance, for the investors' decision making, and to enforce the fair information, for fair presented information. So OJK put a specific explicit clause stating that for misinformation, then will be, or error in presenting the information will be subject to financial penalties. Other than that, also in the new exposure, draft exposure of the regulations, OJK also mentioned for greenwashing also will be subject to financial penalties, and not just financial penalties. For more extreme case, will affect the revocation of license and etc. So they are very serious and understand the the importance of the information presented under the sustainability report.
And likewise, if I just jump straight in, if you don't mind. Likewise, yeah, Singapore has built enforcement mechanisms, if you like, into the regulatory infrastructure. I think it's also important to note that the emphasis from the standard setters and from a lot of regulators is also about the market response. So when you get questions about what good looks like or what materiality thresholds need to be set at internally and so on, the answer that's often given is, the market is going to judge your decisions. The market will judge your disclosures. But that also means that the market has to be made ready to use the information, has to be ready to price the information and build it in. So I think that's the other side of enforcement. There's what's enshrined in the law, but the other side of enforcement is also about enabling those market mechanisms so that if companies are not adhering to the norms of their sector for disclosures, or they are falling short, they're not just facing penalties, but also facing the market response where investors are losing confidence. I think that loss of confidence among investors, that is quite an accomplishment to get to the point where these disclosures are taken that seriously. And quite a lot of work needs to be done with investors as well about how to use and interpret the disclosures. Sorry to slightly redirect, but I think it's really important to enable those market mechanisms here.
Okay. Okay. My question earlier was, what if uh, they do not put disclosures? Okay. What about if their disclosure is not complete? Is there any plan in the directive or in the regulators memorandum that somebody else also has to review it for completeness? Because there might be cases wherein, okay, we'll just put a disclosure just to comply, right? So is there any plan for that, that there will be review of what disclosures are being made? Because just like climate change, that's pretty obvious, right? That is actually pervasive in nature. It's not only limited to, it's not isolated to one company. So, what about, is there any provision in the regulation that there will be a review on the completeness of the disclosure?
I don't recall on the regulations that there is a specific requirement, but as this will be part of the general financial information of the company, which usually been submitted together with the annual report, and also at the first page of the sustainability report itself, the directors under separate regulations, the directors need to make a statement about the completeness and also the fair representation of the report. And they also acknowledge that they do have internal controls, effective internal controls to ensure the reliability of such report. And then usually it gets signed by the board of, because in Indonesia we adopt two-tier boards. So those reports are signed by both the board of directors and board of commissioners. So the development in Indonesia, because of such requirement, for more matured company, where they already adopted internal control over financial reporting, they also adopt new sets of controls called as the internal control over sustainability report.
Oh, man, that's good.
And I would say a big part of the conversation comes back to what I said about audit. Is the audit market ready to really be providing assurance of this, whether in a limited or reasonable capacity? So again, that's a huge part. And I think what you see in the timeframes for disclosure, it's very much mapped onto what level of assurance by which certain dates as well in most jurisdictions. The other thing that I think is really important to note is, yeah, okay, it is possible for companies to provide a limited disclosure just to try and tick a box. But what the ISSB is saying with its standards very consistently is during the capacity building phase, there are transition reliefs to make it easier. There is proportionality. You make a proportionality judgment around what's in scope. And your main job to be credible in a disclosure is to communicate your gaps, communicate what you're not yet able to do and how you're going to be able to do it in future. Now, companies don't typically love doing that, but the ISSB is saying that credibility is a disclosure that's very good in certain areas and has lots of omissions with a clear plan for addressing those omissions or addressing those gaps. So ISSB, every single webinar I go to, every time I speak to them, this is being reinforced as well. So transparency about how you're building the skills and building the knowledge is key. And I think this may link to a couple of questions in the chat, but still, I'll come back to you, Dr. Noy.
Okay, thank you, Dr. Robert and Madam Sojuno. Yes, after all is said and done, what matters is the bottom line, right? So, the preparers of financial statements, the auditors need to be very vigilant about this, and this needs a lot of learning rather than what they have learned just now, right? Okay, so I think we are on the same boat that there's still a long way to go with regards to sustainability reporting, and it is imperative that this has to be connected to the financial statements. I cannot see any question in the chat box, so I suppose there's no more clarifications. But anyway,
Dr.
Madam
Tinoy,
Sujono and yes.
if I might interrupt, I've received one or two. I don't know if they're just coming to me and not to you. But perhaps would you like me to read one out that's come directly to me?
Oh yeah, yeah, sure. Because I'm opening the chat box. There's nothing here.
Okay, well,
But if
one
there is anything
question.
that goes directly to you, can you
I'm sure the
please read
moderator.
that? And then yeah, can you
Yeah, I'm
please
sure
read
the
that?
team can send them through to you as well. One that I've got now that maybe Juliana, this is better for you, is does net zero commitment need to be disclosed in the financial statement as well? Or is it enough to only do that in the sustainability disclosures?
Generally, net zero commitment only being disclosed at the sustainability disclosure. But again, therefore, we need the accountant perspective here because some of the commitments actually might affect the financial statements. For example, within the net zero commitment, then the company already entered into an agreement to replace the internal combustion engines vehicle into EV vehicle, and they already have 3 years agreement with the suppliers to replace all their existing vehicle into the EV vehicle. So you need to consider whether or not such event will affect your useful life of the assets, or if the purchase has not been done, then you also need to consider whether or not the disclosure over commitment also need to show such effects in your financial statements. So it's not the full net zero commitment has to be included in your financial statements, but you need to assess one by one whether or not such event or such commitment will have an impact on your financial statements based on the accounting standards. I hope that's clear.
Yeah, I think so. Now, yeah, there's some question here. What if the regulation itself is so uncertain due to political climate in certain jurisdiction that the transition risk is also very unclear of the impact? Should companies still disclose the effect of those transition risk? I think transition risk and physical risk was exhaustively discussed by Madam Sujono, right? So can you please clarify this one?
Yeah, usually when we assess the whether or not such event would be material to the company, we'll look at the likelihood and also the magnitude. So, for example, on carbon tax, yeah, we understand that the timing of the issuance of the carbon tax or the regulations imposing carbon tax, for example, is still uncertain. But when the regulations become enacted, then it will have like significant implications to the company. Usually, several companies will include it in the sustainability report, but clearly mentions the situation that right now the government has just requiring such such tax for a certain sector, but if it is being enrolled to other sectors, then the company will experience a decline in net income, for example, with certain range because of the emission profile. Yeah, if and only if the impact would be material and significance for the primary users of the financial of the sustainability report.
Okay. Dr. Robert, do you have any comment regarding that?
I think that's a very, very good coverage off on transition risk. I've seen this quite a few times in different jurisdictions, and even okay, there was one client, the chemical manufacturing client I talked about in the talk. They dealt with the European Union market quite a lot. Now, even though there's quite a good amount of policy on the EU's direction, the exact levels of ban and what time period and how many products will be affected is still very uncertain. So this is why for anything around transition risk, I find the ranges are very important. And it's important to be able to state what you believe is the best case and the worst case for that range with some evidence. And if you've got very low confidence, it might be that you decide not to disclose, but typically the ranges are significant. And the fact that range is so large and the notes to explain that range will highlight that uncertainty as well. I find with physical risk, there are still ranges that you use. It's not always as important. It can be there depending on how you want to communicate the information. But with transition risk, yeah, because it's policy based, the question's absolutely spot on. Because it's policy risk, it's really challenging.
Okay. From Ibu Lindawati Gani. For Dr. Robert, based on your experience, how ready are companies in providing the data and information to support and facilitate the estimation of business and financial impact, which will be connected to the financial statements?
Good question. I would say that the team that's coordinating the work is very nervous about doing this, and they typically worry that they won't have the data. But when they then go to speak to the managers of specific facilities, of specific sites, specific warehouses, operations, those managers have the data. So I find that in my experience, the core team is not ready and they're nervous about this. But when they reach out to the right people in the operations side, the data comes back relatively quickly. The data might be not quite what you're looking for. It might be a different data point than the ideal one, but you can normally find a way of using that by tweaking the input equation, in my experience. But I would say the main challenge here in bringing that data together is you need your colleagues to be willing to give their time and resource to those data requests. And these people are busy. So if you think about the governance aspect of the standard, it's also really important because your colleagues are much more willing to give you time to do a data request if the CEO and the whole board are saying it's vital. So if this is perceived as an irrelevant process, they may well ignore your data request. If, on the other hand, the tone from the top is that this is vital and important for strategy and compliance, then colleagues are much more willing to work and give the data. So the data exists, it's just the team doesn't normally have it at their fingertips.
Okay, thank you. I think there's another question from Mr. Ahmad. Can you flash that on the screen, please?
It's a good question, this one.
Yeah, from Mr. Ahmad Junaidi, for to the two speakers. How should companies manage conflicts, because there will be, right, between financial materiality and impact materiality when both lead to different disclosure priorities?
I'm very happy to comment. I think this is a great topic to talk about. First off, obviously the S1 and S2 standards focus on financial materiality. For people who are paying very close attention, they will look at carbon accounting and ask whether that is financial materiality or impact materiality, or sits in a gray zone in between the two. And I would say that's the point. There is this gray area. And in part, that's because what is an impact material topic today can very quickly become financially material as time progresses. So if you really want to understand this dynamic between the two, the term that I use typically is dynamic materiality. You might not use that in your disclosure, but understanding the dynamics between how impact materiality can lead to financial materiality is an
Yes.
important thing you need to learn in your risk assessment work. And you can't just ignore things. So, for example, you can't ignore your greenhouse gas emissions. Now, in Singapore, that makes sense because there's clear carbon pricing mechanisms in place. But in a jurisdiction without a carbon price, greenhouse gas emissions are arguably just impact materiality. But the point is, it leads through to financial materiality in future. So yes, there can be trade-offs, but I think for the S2 perspective, it's important to primarily be able to communicate impact materiality as the potential future financial materiality as well. That's if you just want an S2 approach, that's what I would really focus on. I'll stop there. I'm aware of time. There's so much more I could talk about on this. It's a really good question.
Okay. I think there are two more questions. I think we can deal with that before we will close the session. So from YU Relvi, for Dr. Robert, what are the most challenging aspects your clients face when implementing sustainability disclosure? Additionally, how do organizations manage to disclose important environmental risks without damaging or threatening their corporate image?
Okay. I'm going to answer this in a very specific way, which is when there are clients and companies that have quite limited budgets. Okay, if it's a large company that can hand everything to an external party, then that's one way of handling it. If a company has a very limited budget for external engagement, I would typically advise them to bring in the external parties for the climate modeling work. So populating the risk register, for example, and then also calculating the financial impacts potentially as well. I think there's actually a lot that companies can do in-house if they have the resources and time and can be sent on training for it. It's not easy. I'm not going to say this is straightforward at all, but I would say that when you have to start accessing the climate models to draw out data from the climate science, I think that's where external support is often most needed because it's very challenging to learn. It's not impossible to learn, but I would still spend a couple of weeks working with somebody to teach them that side of it. So I think that's key. And then in terms of disclosing it without damaging or threatening the image, to me, this is the same question for any risk. The fact it's environmental, I think, is hopefully something that shouldn't be that important. You're communicating material risks, and as you would with any material risk, it's about demonstrating that you have that awareness and that you've got a relatively strong plan in place. The difficulty is when companies will disclose risks without any transition plan, without any response mechanism in place, or companies will disclose all of the environmental opportunities and only like one or two tiny little risks here. It just doesn't look credible. So what you're looking to do is sound like you've done a credible assessment of your material exposures and that you have an action plan in place for mitigating those or dealing with them, and that it's been resourced, or exactly how Juliana explained in her talk, to be honest, it was spot on. And it's showing that careful risk management is really how you navigate the reputational concern. Yes. Thank you, though. Really, again, good question.
Okay. Okay, we'll have the last question of the day from Miss Catherine Lee. Given high level of judgment required in quantification of climate impacts, would we see more increased deliberate instances of understatement of profit via increased cost inputs? Companies will take opportunity to post higher operational cost under the guise of climate impacts at possibly every opportunity. So I think the comment of both speakers would be much appreciated.
Maybe I'll start on this one, Robert, if you don't mind. For me, I think this is my personal view. For accounting implications and recording, because it is historical, right? So it still depends on whether or not the event has occurred. But on certain conditions, and not all, there is a possibility that uh, the climate events might affect the fair value, for example, for example, for bank, for the collateral of the assets that the bank take for the loan they give to the debtors, right? In that case, then companies need to assess whether or not that will create like additional impairment required for the impairment of the loan, yeah, required to be taken for the financial statements. But doesn't necessarily that, all the sustainability disclosures will affect as additional adjustments to the financial statements, because financial statements will still use the existing accounting standards to recognize the recordings in the financial statements.
Yeah, and I think that's exactly where I would have gone as well with this. The job of these standards is not to change or replace the core accounting standards. It's simply, I always say, it's simply to convert the science of climate or the science of biodiversity or whichever topic you're looking at, convert that science into a format that you can use in your normal systems. So really, how would your normal risk management process work? How would the accounting standards require these things to be recognized? So that's what this typically comes back to. And if I think Catherine's identified a really core motivation, a dysfunctional consequence potentially of this. And with anything like that, I would say it also then comes down to the assurance process in trying to capture some of this, but then also the market response. And I say that because while you won't get a norm for disclosures across an entire jurisdiction, you will start seeing norms arise in certain industries as well about what typical responses are. And so unless the entire industry starts going down the dysfunctional consequence type route, then I think it's going to be still possible to catch the people that have unusual responses. And I think that's the most I can really say is, just to end on one point here, forming an industry level network of good practice is really important with this. For maturing climate risk assessment, for maturing your carbon accounting, industry level networks need to take over. We have the global standards, we have national level standards and jurisdictional regulatory frameworks. Industries can now take things forward in terms of really improving good practice.
Well, yeah, my as rejoinder to that, I would say that counting standards still prevail. And probably it's a matter of values like integrity, transparency, and all those things which will actually prevent those those things to happen, right? I don't know. Anyway, okay, I think that would be the last question for the day. And I would like to congratulate the 543 individuals who are still in the room. Uh, Thank you for participating. And of course, our congratulations and thank you to our speakers, Madam Juliana Sujuno and Dr. Robert Charnock. Thank you very much.
Thank you. Thank you very much.
Back to the MC, please. Yeah, Monica.
Tes, Dr. Noe, can you hear me?
Yeah. Yep.
Okay. Thank you very much for Dr. Noe, Dr. Robert, and also Ibu Yuliana Sujono for a very fruitful discussion. Um, Next, I would like to inform to everyone, to the participant who join us via Zoom, also via YouTube channel, that we are invite them to join our post-event survey to obtain e-certificate. This link is provided on the chat box and also on your screen. We will open this survey until 12 by lunchtime, 12 Jakarta time. Okay, ladies and gentlemen, that's the end of the webinar session. On behalf of ACPACC, IAI, and AFA, we would like to deliver our sincere gratitude to our speakers, our moderators, to all the guests, and every participant who joining us today. Please do not forget to join our post-event survey to obtain the e-certificate. My name is Monica Nabilia. Thank you for your participation. I see you on our another event. Thank you.
Thank you, guys.
Thank you, ladies and gentlemen. We would like to remind you to join our post-event survey. Yes. Okay, ladies and gentlemen, we would like to kindly remind you to join our post-event survey. The link will be available until 12 Jakarta time. We will soon close this webinar room. Thank you, and we see you again on our next ACPACC webinar. We will close this webinar room in 3, 2, 1. Thank you.